So let's get started here on the chapter 14 to 17 review. So our first question here says, Robles Corporation was organized on January 1st, 2016. During its first year, the corporation issued 2,000 shares of $50 par value preferred stock and 100,000 shares of $10 par value common stock. Then at December 31st of each of the following years, the company declared the following cash dividends. So in 2016, they declared $5,000 of dividends, 2017, $12,000, and then in 2018, they declared $28,000 worth of cash dividends. So we need to show the allocation of dividends to each class of stock, so preferred versus common, assuming that the preferred stock dividend is 7% and cumulative. So we first need to calculate to figure out how much preferred shareholders are supposed to be getting each year. And there's going to be a calculation here. So the annual preferred dividend will be your number of preferred shares times the par value for preferred stock times the percentage that they give you. So if we take a look at the information given to us, we have 2,000 shares of preferred stock. Its par value is $50, and our percentage is 7%. So if we plug all of that information into our formula, we get 2,000 times 50 times 0.07, which ends up giving us an annual preferred dividend of $7,000. So what that's saying is that every single year, your preferred shareholders should get $7,000 of dividends. So we'll remember that as we move on into allocating our dividends now. So we'll start with 2016. Down along the bottom of this chart, you'll see the total amount of dividends for each year. In 2016, we declared $5,000 worth of dividends. That's a bit of a problem, right? Because your preferred shareholders are supposed to get $7,000. So, preferred shareholders will get all $5,000 that we were supposed to pay out in 2016. They can't magically get their $7,000 even if we aren't going to pay it out, right? So they get as much as they can of that $7,000. So if $5,000 are going to preferred, there's nothing left over for common. So common shareholders will only get what's ever left over at the end. Now, that means that we owe $2,000 to preferred shareholders, right? Because they're supposed to get $7,000 every year. We only paid them $5,000 this year. So we owe them that $2,000 difference. So since it's cumulative, that means that that $2,000 is going to have to be paid to them in the future. If we were told that this is 7% and non-cumulative, that means that if preferred shareholders miss out on $2,000 of dividends, they miss out on that money forever. But here, they're lucky, it's cumulative, they get this money later on. So we take a look at 2017. In 2017, we declared a total of $12,000. So now we need to split up this $12,000 between preferred and common. Well, preferred are supposed to get $7,000 every year. And then they're also supposed to get that $2,000 that we owed them from the previous year. So we can pay them here $9,000. We can pay them their $7,000 that they're supposed to get for 2017, plus the $2,000 that we owed them from previous years. So preferred shareholders can get a total of $9,000 of dividends this year. So if we're paying out $9,000 to our preferred shareholders, that means that there's only $3,000 left over for our common shareholders. So now we move on to 2018. In 2018, we declared a total of $28,000 of dividends. So we need to split up that $28,000 between preferred and common shareholders. Well, preferred are supposed to get $7,000 every year, right? That was our annual preferred dividend that we calculated on the last slide. Well, here they just get their $7,000. They weren't owed anything extra, right? We didn't owe them anything from previous years anymore. And so we just pay them the $7,000 that's decided by taking those number of shares times the par value times our percentage. Right? So preferred gets their $7,000. Common gets whatever is left over. So there's a total of $28,000. $7,000 of it goes to preferred. $21,000 goes to common. Now remember, when you're looking at these numbers, in this problem, there were 2,000 shares of preferred stock, and there were 100,000 shares of common stock. So even though more money is going to common stock here in 2018, there's less per share, right? Because there's so many more common shares out there than there are preferred. So being a preferred shareholder, you still get a better return per share. So that is going to be how we figure out the allocation of cash dividends between preferred and common stockholders. Remember that preferred gets their money first. Then if anything is left over, common just gets the rest. Now we can move on to question number 2. So this says, on January 1st, Klosterman Company issued $500,000, 10% 10-year bonds at 102. Interest is payable annually on January 1st, and we need to prepare some journal entries. We need to prepare the entries to record the issuance of the bonds, the accrual of interest, the payment of interest, and then the payment of the bonds at maturity. So we have all of the important information over there on the left. So here on January 1st, 2019, Klosterman Company is issuing these bonds, right? So when a company is issuing bonds, what are they getting in return? Well, they're getting cash, right? A company is going to issue bonds to help them finance a project. It's just a way for them to get an influx of cash. So we'll debit our cash here. And we'll credit bonds payable, because if people are giving us money, we're eventually going to have to pay them back. So we have a liability account here for bonds payable. But you'll notice there's a gap there on the screen right now between cash and bonds payable. That's because of that at 102. What that's saying, whenever you issue bonds at 102 or anything above 100, that means that you're issuing them at a premium. So we have to credit the premium on bonds payable. If we were issuing them at 98 or at 94, right, anything below 100, we would be issuing them at a discount, and that's when we would debit discount on bonds payable. So now we can figure out these numbers here. Bonds payable itself will always be the face value of the bond. So that's the $500,000 here in this case. Our premium is $10,000. How do we find that? Well, we issued it at 102. What that's saying is that we're issuing these bonds at 102% of face value. So your premium is that 2%, that part that you are over 100. So if we take 500,000 and multiply it by 0.02, you'll end up with 10,000. So that's our premium on bonds payable. Now cash, there's a few different ways that we can find cash, right? The simplest way, debits and credits have to equal. So we know our two credits are 500,000 and 10,000, so cash must be the sum of those. Another way that we can find cash is going back to that 102. So if we are issuing bonds at 102, that's 102% of face value. So if you take your face value, your $500,000, and multiply it by 102%, or 1.02, you'll end up with 510. Right, so that's another way that we can find that cash amount. So that's our journal entry for the issuance of the bond. Now for the accrual of interest on December 31st, 2019. So you'll notice that we were given 10%. This is when that 10% will come into play. That's an interest rate on these bonds, right? So we are the one that will have to eventually pay the interest on these bonds. So we deal with accounts like interest expense and interest payable, right? So we debit interest expense and we credit interest payable. You'll notice again, there's a space between those two accounts. That's because we also need to amortize our premium. It's a fancy word for just decreasing the balance in that account, right? So you'll probably see stuff like amortization of the premium in your textbook or on your homework assignments. Just know that that means that you have to decrease the amount in your premium or your discount account. So there's a process here. We're first going to be calculating our interest. So that's your principal times your rate times your time. So our principal is 500,000 times our interest rate of 10% times 1, because it's been one full year. So you find that your interest is 50,000. Well, we sort of have a 50-50 shot now of putting it in the right spot, right? We could put it up in interest expense, or we could put it in interest payable. Here's how we can remember this. When people gave you this money back on January 1st, they were told that they would get 10% interest, right? So you're contractually obligated to pay them that amount. So your 50,000, the calculated amount for your interest, goes into your interest payable, because that's the amount that you're going to have to pay them later on. Now, the next piece is your premium on bonds payable. This is when we amortize our premium. So our premium on bonds payable was $10,000, right? It's a 10-year bond. So if we take 10,000 divided by our 10 years, we get 1,000. So we will debit our premium on bonds payable for 1,000. So now our interest expense is 49,000. We get that by just taking our payable and subtracting our premium. So now we can move on to January 1st of 2020. This is when we are paying the interest to these people, right? We're told interest is payable annually on January 1st. So we have to decrease what's in our interest payable, and we're using cash to pay them. Now, how do we figure out the number here? Well, we look at the entry that we made back on December 31st. The amount for our interest payable was $50,000. So that's the amount that we will use in this entry when our interest is being paid. Now, the payment of the bonds at maturity. So 10 years have passed since we issued these bonds, and so now we need to pay everyone back. So if we pay everyone back, we no longer owe them money, right? So we want to debit our payable to make that liability account decrease. And how are we going to pay them? We're going to use cash, right? So we debit bonds payable and we credit cash. And that's just for the face value of these bonds. So those are your journal entries around the issuance of bonds, the accrual and payment of interest, and then the payment of the bonds at maturity. Now, in this next question, we're told that the balance sheet for Miley Consulting reports the following information on July 1st. So, on our balance sheet, we had bonds payable of $1 million. We still had $60,000 of a discount on our books. And then you'll see that $940. That $940 is called the carrying value. It's sort of like the book value of your bond. So on our books, that bond is worth $940,000, which we get by taking our bonds payable and subtracting out that discount. Then it says Miley decides to redeem these bonds at 101 after paying annual interest. Prepare the journal entry to record the redemption on July 1st, 2020. So, we have our journal entry here. If the bonds are being redeemed, that means that we have to pay this money out right now. And if we pay the money out, we get the bonds payable off our books, and we're going to have to use cash. Right? So we want to debit bonds payable and credit cash. But there's going to be a few other accounts in between there that we're going to have to deal with. Another piece of information that we're told is that we had a discount on our bonds payable still on our books. Well, if these bonds are being redeemed, we need to get that discount off of our books. So a discount has a normal balance of a debit. So to get that balance off of our books, we credit discount on bonds payable. So we still have another account. You'll notice there's still a gap between bonds payable and our discount. But let's fill in the numbers that we know so far. Bonds payable, that was the $1 million. Discount, that was the $60,000. Now for cash, there's going to need to be a calculation. So for cash, what we're going to do here is we're going to take the face value of our bond and multiply it by 1.01. And that's because Miley is redeeming these bonds at 101. So that's at 101% of face value. So our face value, that's the 1 million. We multiply 1 million times 1.01, or 101%. And we get 1,010,000. So we put that in there for cash. So now the last account here is either going to be a gain or a loss on this bond redemption. Well, to figure that out, what we do is we compare our cash amount to the carrying value that we were talking about earlier. So our carrying value is $940,000. That's what it's worth to us on our books. We are paying out $1,010,000. So since our cash is greater than our carrying value, we're going to have a loss on the bond redemption. And this loss is $70,000. That's your cash amount minus $940,000. Another way that you can figure this out, we needed to add more over to the debit side of this entry, right? If we need to add more to the debit side, it's going to be a loss. If we needed to add more to the credit side, then it was going to be a gain. So here we needed to add $70,000 more to the debit side to make our debits and credits equal. So that's how we find out that it's a loss on bond redemption. So we lost some money here redeeming these bonds. Now we can move on to question number 4. So question number 4 says, Nosker Inc. had the following transactions pertaining to investments in common stock. So back in chapters 13 and 14, you were dealing with issuing stock yourself as the company. Well, now you are investing in other companies' stock, right? So you are Nosker Inc. in this case, and on January 1st, you're purchasing 2,500 shares of Escalante Corporation common stock. So you're investing in Escalante Corporation. Then it says 5% for $152,000 cash. What does that 5% mean? Well, what that's showing us is the percentage of ownership that we have in that company. Because if we own a certain percentage, we have to change the way that we account for all of this. So we own 5% of Escalante Corporation. That's going to come in handy to know that once we start doing these journal entries. Then on December 1st, we were told that we sold 500 shares of that stock for $32,000 in cash. And we need to now journalize these transactions. So we can go piece by piece here. On January 1st, or before we even do that, we own 5% of Escalante Corporation, right? So we have this chart here. If we own 5%, we don't have significant influence, and so we need to value our investment using the cost method. So we're going to be using the cost method journal entries here in question number 4. So now on January 1st, we are investing in another company's stock. So we call that stock investments. Now, how are we investing in that stock? We're using cash, right? This common stock cost us $152,000 in cash. So we will debit our stock investments and we will credit our cash. To figure out the numbers for this, it's the amount of money that you spent to purchase all of these shares. This investment cost you $152,000. So we will debit stock investments and credit cash for $152,000. Now, on December 1st, you sold 500 shares of Escalante Corporation common stock for $32,000 in cash. So we got cash, right? So our cash has to be debited, has to increase here, because we just sold these shares and got money in return. And we're selling some stock investments. We're selling 500 of these shares that we purchased at the start of the year. So we have to credit our stock investments to show that that account decreases. Cash, that's $32,000. That's the amount of cash that we got when we sold this stock. Stock investments, it's not just going to be $32,000. For stock investments, we need to calculate that. So we go back to when we purchased all of these shares. We purchased 2,500 shares for $152,000. Well, we can divide those two numbers to figure out how much per share we spent. So 152,000 divided by 2,500 ends up giving you $60.80 per share. So we spent $60.80 per share back on January 1st. So now, here on December 1st, we sold 500 shares. So 500 times the amount that we bought these shares for, the $60.80, we multiply those two together and we get a stock investments amount of $30,400. So your stock investments are valued at the cost that you paid for these shares originally. Right? So you paid $60.80 per share. You sold 500 shares here on December 1st. We take 500 times $60.80, and that's how we get our $30,400. So you'll notice your debits and credits don't equal. So you sold stock that was worth to you $30,400. But you were able to get someone to pay you $32,000. So you had a gain on the sale of stock of that difference, that $1,600. Right? Because you were able to get more cash than what your stock investments were worth to you. So now we can take a look at question number 5. So we need to prepare the journal entries for Knoller Company for the following transactions. Knoller Company acquires 25% of the common stock of Lauer Company for $150,000 on January 1st, 2019. So you see right off the bat, you now own a quarter of Lauer Company. In that last problem, you only owned 5% of Escalante Corporation. So now you own a lot more of another company, right? So this is going to be using a different method here in this question than we did in question 4. So after we acquire 25% of the stock, then it says at the end of the year, Lauer Company reports a net income of $180,000 and declares and pays a $50,000 cash dividend. So we have a few journal entries that we need to record here. But before we do that, we take a look back at this chart. We own 25%. Well, 25% falls between 20 and 50, so significant influence usually exists, and the investment will be valued using the equity method. So it's just a different way of recording our stock investments. Right, so on January 1st, you acquired 25% of the common stock of Lauer Company for $150,000. So you have a stock investment and you used cash for $150,000. Right? So that doesn't look any different compared to when we bought shares of Escalante Corporation in the last problem. It's these next entries that are a little different now. So, since you own between 20 and 50%, you now get some of the net income. You're going to be getting some of this cash dividend here now too, right? So, on the 31st, we first want to journalize your portion of the net income. So we will debit our stock investments and we will credit the revenue from stock investments. So this is to record your part of the net income. Now, Lauer Company reported a net income of $180,000. That's the company as a whole. You don't get all $180,000. You only own 25% of the company. So, you get 25% of the net income. So if we take 180,000 times 0.25, you'll end up with 45,000. Now, we also need to record this cash dividend that you get. So if we get a cash dividend, we'll be getting cash, right? So our cash has to go up. But all of a sudden now our stock investments are going down. What's happening there? Well, your stock investments act like a company's retained earnings, right? So net income makes retained earnings go up. So that's why we debited stock investments there in our second entry. But here, whenever a company pays out dividends, that makes a company's retained earnings go down. So your stock investments will be credited when you are recording this cash dividend. Now, Lauer Company is paying a $50,000 cash dividend. Again, you don't get all of it. You own 25% of the company, so you get 25% of the cash dividend. So 50,000 times 25% gives you 12,500 for your cash dividend amount. So that's the equity method. Now question number 6, our last question here, deals with chapter 17. So chapter 17, you are finally reintroduced to the statement of cash flows, right? Way back in chapter 1, you were told it's one of the financial statements and you'll learn about it later. Well, you're finally learning about it here in chapter 17. So, it says Cushenberry Corporation had the following transactions. Determine how each transaction would affect the statement of cash flows. So we have 6 different transactions here, and we'll go piece by piece. But before we even do that, let's talk about the different parts of a statement of cash flows. So we have 3 different types of activities. We have operating activities, investing activities, and financing activities. So there's some common examples here for each type of activity. So operating activities will include changes in current assets. So that's stuff like accounts receivable, inventory, supplies. Changes in current liabilities. So that's your accounts payable. A gain or a loss on the sale of plant assets. And then any kind of non-cash expenses. So stuff like depreciation expense, right? If we depreciate our equipment, we're not actually spending any money. But it affected our net income. And our operating activities are all just adjustments to our net income. Now we can move on to investing activities. So investing activities are going to be proceeds from the sale of plant assets, right? So if you sold equipment for $10,000, the proceeds is how much money did you get from that sale? So that would go under investing activities. Anytime that you purchase plant assets, that's building, equipment, land, right? These are all investing activities. Anytime that you sell investments, that's going to be an investing activity. And then we move on to financing activities. So this is how a company can finance their business, right? We use that term early on talking about bonds, where a company uses bonds to finance a project. Well, this is just ways for them to get money, right? So issuing common stock, issuing bonds, anytime that they pay dividends, or anytime bonds are redeemed, right? So these are just some examples. These are not the end-all be-all of statement of cash flows. But if we have these in place, we can figure out which section different transactions will affect. So let's start off with this first transaction. So you've sold land that cost $12,000 for $15,000. So there's a few different pieces here to this transaction. We got $15,000, but the land that we sold was only worth $12,000. So that means that we also had a gain in this sale as well. So let's first take a look at the proceeds, right? We had $15,000 as our proceeds from the sale. Well, we were told that proceeds from the sale is an investing activity. Now, another important piece here when doing a statement of cash flows is figuring out, is this going to be added or subtracted on the statement? Well, it's all about what's happening to your cash. So if we sold land for $1,500, that means that we got $1,500. So we would add that $15,000 to our investing activities. And then we had this gain on the sale of $3,000, right? $15,000 minus $12,000. Well, a gain or loss on sale of plant assets, we see that over there under operating activities. So it goes under operating activities. But then we also see a negative. So what's happening there? Well, remember that your operating activities are adjustments to your net income. So your gain on the sale of equipment would have increased your net income, right? Because it's added on an income statement. But you didn't actually get $3,000 more dollars. And so we have to adjust our net income to show just the cash flows. So we have to subtract out that gain of $3,000. If we had a loss, that would have artificially decreased your net income. So we would have had to add in a loss. So there's some backwards thinking when going through a statement of cash flows. The way to get it down is just to practice it over and over again, right? Because anytime that you see a gain on a sale, you'll know I need to subtract that from the operating activity portion. Now, issued common stock at par for $20,000. So we take a look over at all of our activities, and we see under financing activities, issuance of common stock. So this is a financing activity. Now, why is it a positive? Well, if we issue common stock, and people give us money for it, that means that our cash is increasing, right? Our cash is increasing here by $20,000. So we would add that under our financing activities. Now, recorded depreciation on buildings for $17,000. So depreciation on buildings. Well, we aren't buying or selling the building, so it doesn't fall under investing activities. It's not common stock or bonds or dividends, so it's not a financing activity. We take a look up at operating, and you see those non-cash expenses, right? So depreciation expense is a non-cash expense, and so it goes here under operating activities. And we're back to the weirdness that is adding and subtracting under operating activities, right? So non-cash expenses all have to be added in from the same idea, the same perspective as why we add in losses and we subtract out gains on sales, right? Depreciation would decrease your net income, but you never actually took $17,000 out of your pocket and handed it to someone. So your cash flow didn't actually get affected. So we have to add back in that $17,000 to reconcile our net income to our cash flows. Now, paid salaries of $9,000. This one's a little tricky. So, this is not listed on the statement of cash flows. And why is that? Because your salaries and wages expense would have already affected your net income, which is at the top of the operating activity section. So, you don't have to then make any sort of adjustments to your net income there. So your salaries and wages expense will not show up as an individual line item on your statement of cash flows. It would have just affected your net income originally. Now you issued 1,000 shares of $1 par value common stock for equipment worth $8,000. So, we are getting equipment by issuing some common stock. So, we can be thinking, okay, financing activities, investing activities, right? Plant assets fall under investing, common stock falls under financing. Well, we need to first remember the name of this financial statement, right? The statement of cash flows. At no point in this transaction did any cash flow anywhere, right? We purchased equipment with stock. So, it's not listed on your statement of cash flows because cash is never involved in this transaction. So the first question that you have to ask yourself when evaluating these transactions are, is cash involved? Right? Here, the only two pieces that are involved are shares of stock and equipment. And that's it. Now the last one here, you sold equipment which cost $10,000, had accumulated depreciation of $7,000, and you sold it for $1,200. So, we have another multi-piece problem here again, right? The proceeds from the sale are $1,200. Well, the proceeds of the sale, that goes under investing, right? And if we are selling equipment, we are getting cash, so we add it under our investing activities. But then we had this loss on the sale as well. We find this number by taking your cost, your $10,000, subtracting out your accumulated depreciation to find your book value. So our book value is $3,000. We compare our book value to the proceeds from the sale. So 3,000 minus 1,200 is at 1,800, right? And we sold it for less than what it was worth on our books. So that's how we know it's a loss. So now we try and figure out, okay, where does a loss on the sale of equipment go? Well, loss on the sale of a plant asset, which equipment is a plant asset, that's in operating activities. So we put it under operating activities. And you'll notice we add it back in because we have to add that loss back into our net income. So that way we are just looking at our cash flows for the operating activities.